The rain hammered against the glass windows of the downtown Atlanta high-rise like tiny fists demanding entry. Inside the sleek trading floor of Hammond and Sterling Investment Group, Loretta Davis stood frozen, staring at the screen that had just shattered her world into a million pieces. Account balance: $847,362.73. Her hand trembled as she gripped the edge of the mahogany desk. The numbers didn't make sense. They couldn't. Just 6 months ago, she'd been standing in the same building celebrating her first $1 million portfolio. The champagne had tasted like victory. The applause had sounded like validation. Now, the silence was deafening. Have you ever built something so carefully, so deliberately, only to watch it crumble in front of your eyes? Have you ever stood at the peak of success, only to realize the ground beneath your feet was never solid to begin with? This is the story of how I learned the difference between making money and building wealth, between chasing numbers and understanding value, between what glitters and what's actually gold. My name is Loretta Davis, and this is the hardest story I've ever had to tell. 6 years earlier, I was a different woman. At 42, I was managing a small insurance agency in Decatur, just outside Atlanta. The work was honest, stable, predictable. I helped families protect their futures, explained policy details over coffee in living rooms, and went home each evening to know I'd done something meaningful. But meaningful doesn't always feel exciting. I'd watch the financial news during my lunch breaks, seeing traders celebrate market wins, hearing about ordinary people turning small investments into fortunes. The stories were everywhere. A school teacher who made $500,000 on cryptocurrency, a nurse who retired early from stock options, a postal worker who became a millionaire through day trading, the American dream repackaged for the modern age. "You're too smart to be playing it safe," my friend Diane told me one afternoon as we shared lunch at our favorite spot on Peachtree Street. Diane worked in commercial real estate and always seemed to have inside information about the next big opportunity. "Safe pays the bills," I replied, though something in my chest tightened when I said it. "Safe keeps you exactly where you are," she countered, leaning forward with that gleam in her eye I'd come to recognize. "I'm not saying quit your job. I'm saying use what you have to build something bigger. You've got savings, Loretta. Make them work for you." I did have savings. 23 years of careful budgeting, of saying no to impulse purchases, of choosing practicality over pleasure, $87,000 sitting in a bank account earning barely enough interest to keep up with inflation, my safety net, my peace of mind, my ticket to nowhere. That conversation planted a seed that grew roots faster than I expected. I started researching, reading books about investing, following market analysts online, joining forums where people shared their success stories and strategies. Everyone made it sound so simple. Buy low, sell high, follow the trends, trust the data. The language was intoxicating: portfolio diversification, leverage opportunities, exponential growth potential. I felt like I'd discovered a secret world that had been hidden in plain sight my entire life. 3 months later, I opened my first brokerage account with Davidson Trade Solutions. I started small, investing $5,000 in blue-chip stocks that the experts recommended. Within 2 weeks, I'd made $300. $300 for doing essentially nothing. I remember staring at that number on my phone screen, refreshing it over and over to make sure it was real. In my insurance job, $300 meant days of client meetings, paperwork, follow-up calls. Here, it appeared like magic while I was sleeping. The hook was set. I increased my investments. $10,000. Then $20,000. I opened a margin account, which meant I could borrow money from the brokerage to invest even more. My advisor, a smooth-talking man named Richard Chen, assured me this was standard practice. "Leverage is how wealth is built," he explained during our video call, his expensive suit and confident smile making everything seem legitimate. "You're using the bank's money to multiply your returns. When you're right, you're very right. And Loretta, Based on your research and instincts, you're going to be right a lot. The flattery worked better than any sales pitch. Within 8 months, my portfolio had grown to $240,000. I'd more than doubled my life savings. I was averaging returns that Wall Street professionals would envy. Friends started asking me for advice. Diane introduced me to her wealthy clients who wanted to know my secret. I felt brilliant, validated, like I'd finally unlocked the level of success I deserved. That's when Richard introduced me to Hammond and Sterling. "They're looking for private investors with your profile," he said. "Sophisticated, analytical, willing to embrace calculated risk. They have access to opportunities that regular retail investors never see. Pre-IPO deals, private equity, institutional-level trading strategies." The office was everything I'd imagined success would look like. Floor-to-ceiling windows overlooking Atlanta's skyline, traders in crisp shirts moving with purposeful energy, screens displaying real-time data from markets around the world. The air itself seemed to hum with possibility. Brandon Hammond, the founder of the firm, met with me personally. He was 50-something, silver-haired, with the kind of calm authority that comes from decades of winning. "Ms. Davis," he said, shaking my hand firmly, "Richard speaks very highly of your acumen. We don't typically work with individual investors at your current level, but we believe in recognizing talent early." He showed me their track record, charts showing consistent returns of 18 to 25% annually, client testimonials from doctors, lawyers, business owners, all praising the firm's expertise and integrity. "We use algorithmic trading strategies combined with proprietary market analysis," Brandon explained. "Our systems identify inefficiencies in the market before they're widely recognized. We're not gambling. We're executing precision strategies based on data." It sounded sophisticated, scientific, nothing like the risky speculation I'd been warned about. "What's the minimum investment?" I asked, trying to keep my voice steady. "For our elite growth portfolio, we typically require $500,000. But given your trajectory and Richard's recommendation, we could start you at $250,000 with a pathway to increase as you see results." $250,000. Every penny I had, plus the leverage from my margin account. I should have walked away. I should have asked more questions. I should have remembered every lesson I'd learned about things that sound too good to be true. But I didn't, because sitting in that office, looking at those screens, listening to Brandon's calm confidence, I felt like I was finally being invited into the room where real wealth was made, the room where people who understood the game operated on a different level than everyone else. "When can we start?" I heard myself say. Brandon smiled. "I'll have the paperwork prepared this afternoon." I signed the documents on Friday. By Monday morning, my entire portfolio had been transferred to Hammond and Sterling's elite growth platform. Everything I'd saved, everything I'd built, now managed by professionals who promised to turn my $250,000 into something extraordinary. The first month, I made $32,000. The second month, $41,000. By the third month, my account had crossed $500,000. I was officially halfway to my first million. I remember calling my sister Vanessa in tears, happy tears, overwhelmed tears. "I did it," I kept saying. "I actually did it." "What did?" she asked, confused. "I found the path. I figured out how to build real wealth." There was a pause at her end. "Loretta, are you being smart about this? Are these people legitimate?" Her skepticism annoyed me. She was still working her accounting job, still playing it safe, still thinking small. She didn't understand what I'd discovered. "They're registered with the SEC. They manage hundreds of millions in assets. This isn't some scheme, Vanessa. This is how successful people actually operate." "I just want you to be careful." "I am being careful," I insisted. "I'm being smart. There's a difference." I didn't tell her I'd already started borrowing more on margin to increase my position, or that Richard had introduced me to a contact who could help me secure a home equity line of credit to invest even more aggressively. The market's giving us a window right now, Richard explained. Opportunities like this don't stay open forever. The people who recognize them early are the ones who build generational wealth. Generational wealth. The phrase echoed in my mind like a promise. 6 months after joining Hammond and Sterling, my account balance read $947,183. I was so close to $1 million I could taste it, so close to the number that separated the truly successful from everyone else, the number that would prove I'd made the right choices, taken the right risks, trusted the right people. Then Brandon called with an opportunity. "Loretta, we have a situation that doesn't come along often," he said, his voice carrying an urgency I hadn't heard of before. "One of our institutional partners is liquidating a position in a pre-IPO technology company. Artificial intelligence, cloud infrastructure, the kind of foundational technology that's going to define the next decade." "Okay," I said cautiously. "The opportunity is available only to our top-tier clients. The minimum commitment is $500,000, but the projected returns over the next 12 months are conservatively estimated at 300 to 400%. My heart started racing. 300% would turn $500,000 into $2 million. "I don't have 500,000 liquids right now," I said. "You have 947,000 in your account. We can leverage that at a 2-to-1 ratio, which gives you approximately $1.8 million in buying power. You commit 500,000 to this opportunity, leave the rest in your current positions, and 12 months from now, you're looking at a portfolio worth over $3 million. The numbers danced in my head. $3 million from one investment, one decision. "What's the risk profile?" I asked, trying to sound analytical. "Every investment carries risk," Brandon acknowledged. "But this is as close to a sure thing as we see in this business. The company has contracts with Fortune 100 clients. The IPO is already being underwritten by Goldman Sachs. We're getting in at a valuation that won't be available once they go public. When do you need an answer?" "The window closes tomorrow afternoon. After that, the allocation goes to another investor." I spent that entire night staring at my ceiling, running calculations, reading everything I could find about the company. On paper, everything checked out. The technology was revolutionary. The market opportunity was massive. The timing was perfect. At 11 the next morning, I called Brandon back. "I'm in," I said. "Excellent decision, Loretta. I'll execute the trade this afternoon. Welcome to the next level." That was Tuesday. By Friday, the company announced it was postponing its IPO indefinitely due to market conditions and strategic considerations. The stock I'd bought at $42 per share opened the following Monday at $6.30. In 72 hours, I'd lost over $400,000. I called Richard immediately. His phone went to voicemail. I called Brandon. Same thing. I drove to the Hammond and Sterling office. The receptionist looked uncomfortable when she saw me. "Mr. Hammond is in meetings all day," she said, not meeting my eyes. "I'll wait." "I'm not sure that's—" "I'll wait," I repeated, my voice harder than I intended. I sat in that lobby for 6 hours. Brandon never appeared. Finally, his assistant came out with a tablet and showed me a document. "Mr. Hammond wanted me to review the risk disclosure statements you signed when you joined the Elite Growth portfolio," she said gently. "All investments carry the risk of substantial loss. The firm makes no guarantees of returns. You acknowledged understanding this when you signed the agreement." The words blurred on the screen. I'd signed it. Of course I'd signed it. But nobody actually expects to lose everything. "What about the due diligence?" I asked, my voice shaking. "The research? The as close to a sure thing analysis?" Investment recommendations are based on available information at the time. Markets are inherently unpredictable. The firm conducts thorough analysis, but outcomes can never be guaranteed. The legal language was perfect, airtight, Meaningless. I'd lost $400,000 and there was nothing I could do about it. But it got worse. Much worse. The remaining balance in my account was still leveraged. As the market continued dropping, I received a margin call. The brokerage demanded I deposit more money immediately, or they'd liquidate my remaining positions at a massive loss. I didn't have more money to deposit. They sold everything. The stocks I'd held for over a year, the positions that had been profitable, everything liquidated at the worst possible time to cover the margin debt. When the dust settled 2 weeks later, my account balance showed negative $847,000. I didn't just lose everything I had. I was now in debt for nearly $1 million I didn't possess. The next 3 months existed in a fog of shame and desperation. I couldn't pay my mortgage, couldn't afford my car payment, couldn't look my sister in the eye when she called to check on me. The collection calls started within days. The brokerage wanted their money. The home equity line of credit was in default. The margin account debt was accruing interest at 18% annually. I'd spent 23 years building financial security, and I'd destroyed it in less than a year. Every morning I woke up hoping it had been a nightmare. Every morning, reality crushed that hope within seconds. I stopped answering my phone, stopped checking my email, stopped going anywhere except work, where I sat in my small insurance office pretending nothing had changed while my entire world crumbled around me. One Tuesday afternoon, an elderly client named Mrs. Patterson came in to review her life insurance policy. She was 83, sharp as a tack, with kind eyes that had seen too much life to be easily fooled. "You look terrible, dear," she said bluntly after we'd finished the policy review. I tried to smile. "Just tired, long week." She studied for me for a moment. "I've been coming to this office for 12 years. I've never seen you look like this. Whatever's happening, it's more than tiring." Something about her directness, her genuine concern, broke through the wall I'd been building. Tears started flowing before I could stop them. I told her everything: the investments, the promises, the losses, the debt. All of it spilled out in a confession I hadn't known I needed to make. She listened without interrupting, her weathered hands folded in her lap. When I finally finished, she was quiet for a long moment. "My husband lost everything in 1987, she said finally. Black Monday. He was a stockbroker, thought he understood the market better than anyone. We lost our house, our savings, nearly lost our marriage." "What did you do?" I asked, wiping my eyes. "We started over. From nothing. He got a job selling cars. I went back to teaching. We lived in a tiny apartment and rebuilt piece by piece. It took us 8 years to get back to where we'd been financially." 8 years, I repeated, the number feeling impossibly long. "But here's what we learned," she continued, leaning forward. "We'd been chasing the wrong things. We thought wealth meant having more money than other people. We thought success meant impressing people we didn't even like. When we lost everything, we had to ask ourselves what we actually wanted from life. What did you want? Security, peace, enough, not millions, just enough to be comfortable, to help our children, to sleep at night without fear. Once we understood that, the path became clearer, slower, but clearer." She reached across the desk and squeezed my hand. "You made mistakes, Loretta, expensive mistakes, but you're still here. You still have your skills, your knowledge, your ability to work. The debt is real, but it's just numbers. It doesn't define who you are or what you're capable of." Her words didn't fix anything. The debt was still crushing. The shame was still overwhelming. But something shifted in that moment. I realized I'd been treating my worth as a person the same way I'd been treating my portfolio as a number that could go up or down based on external validation and market performance. That night, I did something I should have done months earlier. I called a bankruptcy attorney. His name was James Thornton, a patient man in his 60s who'd seen countless cases like mine. He reviewed my situation with professional efficiency. "You have options," he said after we'd gone through everything. Chapter 7 would eliminate most of the debt, but you'd lose any remaining assets. Chapter 13 would restructure it into a payment plan over 3 to 5 years. Which do you recommend? That depends on what you want your life to look like going forward. I thought about Mrs. Patterson's words, about security, about enough. I want to rebuild, I said, not the same way. Better. Smarter. But I want to rebuild. He nodded. Then we file Chapter 13. It'll be harder, but you'll come out of it with your integrity intact and a better understanding of financial management than 90% of the population. The bankruptcy process was humbling in ways I couldn't have anticipated. Every expense had to be justified. Every purchase is scrutinized. I had to attend mandatory financial counseling sessions where I sat in rooms with people who'd made similar mistakes. All of us learning the basics we should have understood before we started playing with numbers we didn't comprehend. But something unexpected happened during that process. I started learning. Really learning. Not the seductive, simplified version of investing I'd encountered online. The real mechanics of how markets work, how risk is actually calculated, why diversification matters, what leverage actually costs, the difference between speculation and investment. I read everything I could find, not get-rich-quick books or trading strategies, but foundational texts about behavioral economics, market history, portfolio theory. I studied the crashes of 1929, 1987, and 2008. I learned about tulip mania and the South Sea bubble, and every other time in history, humans convinced themselves that this time was different. Patterns emerged. The same patterns I'd fallen for. The promise of easy wealth, the fear of missing out, the trust in authority figures who profited from my participation, the belief that I was smarter than the system. 6 months into my bankruptcy repayment plan, something else unexpected happened. The SEC announced they were investigating Hammond and Sterling for fraudulent misrepresentation and unauthorized trading. Brandon Hammond and Richard Chen were arrested on multiple counts of securities fraud. Turns out the algorithmic trading strategies were largely fabricated. The impressive returns were inflated through accounting tricks. The pre-IPO opportunity that destroyed my portfolio was a well-known high-risk speculation they'd misrepresented as conservative investment. I wasn't their only victim. There were dozens of us, hundreds, eventually. A class action lawsuit was filed. I joined it, though I knew recovery would be minimal. The firm's assets had been systematically drained. Brandon had been funding his lavish lifestyle with client money. Richard had been getting kickbacks for every investor he referred to. The classic scheme, dressed up in modern language. When the news broke, people asked if I felt vindicated. I didn't. I felt stupid for not seeing it sooner, angry at myself for ignoring every warning sign, embarrassed that I'd been so easily manipulated, but I also felt something else. Determined. I started writing about my experience. First in a private journal, then in blog posts I published anonymously. I detailed every mistake, every red flag I'd ignored, every psychological trick that had worked on me. The response was overwhelming. Hundreds of people reached out with similar stories. Single mothers who'd lost their children's college funds, retirees who'd gambled their pensions, young professionals who'd destroyed their credit-chasing returns they didn't understand. We'd all fallen for variations of the same lies. A local community college reached out asking if I'd be willing to teach a financial literacy course. Me, the woman who'd lost nearly $1 million, teaching others about money. The irony wasn't lost on me, but I said yes, because I realized I had something valuable to offer. Not expertise in making money, but hard-earned wisdom about losing it, about the psychology of financial decisions, about the difference between confidence and competence. My first class had 8 students, working adults, most of them middle-aged, all of them carrying their own financial wounds and aspirations. I didn't pretend to be a guru. I opened the first session by showing them my bankruptcy papers. This is what happens when you confuse activity with understanding, I said. When you trust credentials over common sense. When you let fear of missing out override basic risk management. I taught them how to read financial statements, how to identify red flags in investment opportunities, how compound interest works, both for and against you, how to ask questions that separate legitimate advisors from predators. But more importantly, I taught them about themselves, about the cognitive biases that make us vulnerable to manipulation, about confirmation bias, where we seek information that supports what we want to believe, about recency bias, where we assume recent trends will continue forever, about authority bias, where we trust people with impressive titles and offices without verifying their claims. The course grew. 8 students became 15, then 30, then 50. The college asked me to develop an expanded curriculum. Local churches and community centers invited me to speak. I wasn't getting rich from it. The teaching paid modestly, but something more valuable was happening. I was rebuilding my relationship with money, not as a scorecard or status symbol, but as a tool, a resource to be managed with respect and understanding. 2 years into my bankruptcy repayment plan, I received notice that the Hammond and Sterling class action had reached a settlement. Each victim would receive approximately 8 cents on the dollar of their losses. For me, that meant about $67,000. It wouldn't erase the debt, wouldn't undo the damage, but it was something. I used part of it to pay down the highest interest portions of my bankruptcy plan. The rest, I invested. But differently this time. I opened a retirement account with a reputable firm, one with transparent fees, published track records, and fiduciary responsibility. I invested in low-cost index funds that tracked broad market performance. Nothing exciting, nothing promising extraordinary returns, just steady, boring, reliable growth. I set up automatic monthly contributions, small amounts I could afford without stress, the kind of investing that works through consistency rather than brilliance, and I watched it grow, slowly, predictably, exactly as it should. 3 years after my bankruptcy filing, I made my final payment. The debt was cleared. My credit was still damaged, but rebuilding. My savings were modest, but real. I was 48 years old, starting over financially where most people start in their 20s. But I was starting over with wisdom. I wouldn't trade for anything. That brings me back to where this story began, standing in the Hammond Sterling office, staring at the screen showing negative $847,000. Except that's not where I am anymore. Today, I'm standing in a community center in East Atlanta. 53 people are sitting in folding chairs, notebooks open, listening as I explain the basics of retirement planning. Most of them are like I was, middle-aged, working hard, hoping there's a way to build wealth without sacrificing decades to get there. I tell them the truth nobody wants to hear. There isn't a shortcut. There's no algorithm, no insider secret, no hidden strategy that eliminates the fundamental equation of building wealth. Time plus consistent effort plus reasonable risk management. But I also tell them the truth nobody tells you when you're starting. You don't need millions to have financial peace. You don't need to outperform the market to retire comfortably. You don't need to impress anyone with your investment returns. You need to spend less than you earn. Save consistently. Invest in things you understand. Avoid debt that doesn't build assets. Plan for emergencies. Insure against catastrophe. The basics. The boring, unglamorous basics that actually work. After class, a woman approaches me. She's around 45, well-dressed, carrying herself with the kind of careful confidence I recognize. "Ms. Davis," she says, "I have a question I didn't want to ask in front of everyone." "Of course." "I have about $100,000 saved. I've been researching investment opportunities, and I found this firm that promises 18 to 20% annual returns. They have impressive testimonials, and their founder has credentials from Columbia Business School. It seems legitimate, but after hearing your story, I'm second-guessing myself." My stomach tightens. I see myself in her eyes, the hope, the hunger, the vulnerability. "What's the firm's name?" I ask. She tells me. I recognized it immediately. Another variation of the same game. Different names, same promises. "Can I ask you something?" I say gently. "If someone offered you a job that paid double your current salary but couldn't explain clearly what the work involved, would you take it?" She frowns. "No, of course not." "Why not?" "Because if it sounds too good to be true, it usually is." "Exactly," I say. That same logic applies to investments. Legitimate firms don't promise specific returns because they can't. The market doesn't work that way. Anyone who tells you they can consistently deliver 18% returns is either lying or taking risks you don't understand. "But what if they're legitimate?" she asks, and I hear the hope refusing to die. "Then their returns come from risk. High risk. The kind that can wipe you out when it goes wrong. The question isn't whether they might deliver those returns. The question is whether you can afford to lose everything if they don't." She's quiet for a moment. "What should I do instead?" "Open an account with Vanguard or Fidelity. Invest in a target date retirement fund matched to when you plan to retire. The returns will be boring, 7, maybe 8% average over time, but it'll actually be there when you need it." That seems so slow. It is slow, I acknowledge. Painfully slow, but slowly and steady reaches the finish line. Fast and reckless usually ends up exactly where I ended up. She thanks me and leaves, and I don't know if she'll take my advice. Part of me suspects she won't. The siren song of quick wealth is hard to resist. But maybe my words will echo when she needs them. Maybe they'll save her from my mistakes. That evening, I'm home in my small apartment in Decatur. It's not much. 1 bedroom, outdated appliances, carpet that's seen better days. But it's mine. The rent is affordable, the location is safe, and I sleep peacefully knowing I'm not drowning in debt. My phone rings. It's my sister Vanessa. "Hey," she says, "I just wanted to check in, see how the class went." "Good turnout, 53 people. "That's amazing, Loretta. I'm proud of you, really proud." Her words mean more than she knows. For years after the bankruptcy, I couldn't face her, couldn't stand the pity in her eyes or the relief in her voice that she'd avoided my mistakes. Now we talk regularly. She asks my advice about her own finances, not because I'm an expert, but because I've learned to think critically about money instead of emotionally. "Can I ask you something?" she says. "Do you ever regret it? Not the losing money part, but the whole journey. If you could go back and just keep working your insurance job, never take the risk, never try to build wealth, would you?" I think about her question. Really think about it. "No," I say finally. "I don't regret trying. I regret being stupid about it. I regret not educating myself properly first. I regret trusting the wrong people and ignoring warning signs. But trying to build something bigger? No. I needed to learn I wasn't as smart as I thought I was." That's a hard lesson. The hardest, I agree, but also the most valuable. We talk for a few more minutes, then said goodnight. I pour tea on myself and sit by the window, looking out at the Atlanta skyline. Somewhere in one of those buildings, someone is making the same mistakes I made, believing promises that can't be kept, trusting credentials over common sense, confusing complexity with sophistication, and somewhere else someone is doing it right, saving consistently, investing boringly, building wealth is a slow way. I can't save the first person. They have to learn their own lessons, but maybe I can help the second person stay on their path. My phone buzzes with an email. It's from the community college. "Ms. Davis, we've received requests to expand your financial literacy program to additional locations across Metro Atlanta. Would you be interested in discussing a partnership for a broader curriculum?" I smile. 5 years ago, I was standing on a trading floor watching my fortune evaporate. Today, I'm being asked to teach others how to avoid my mistakes. The universe has a sense of irony. I type my response. "Absolutely. Let's discuss details. Because here's what I've learned. Real wealth isn't measured in portfolio balances or investment returns. It's measured in peace of mind, in sleeping soundly, in not checking your phone compulsively, in making financial decisions based on your values rather than fear or greed. Real success isn't about having more than other people. It's about having enough for yourself. Real wisdom isn't about never making mistakes. It's about learning from them and helping others avoid the same pain. I don't have $1 million anymore. I probably never will. But I have something better. I have clarity about what matters, respect for money without being enslaved by it, knowledge earned through pain that I now use to help others. The trading floor didn't make me rich. It made me wise. And wisdom, it turns out, is worth more than any portfolio. If my story resonates with you, I want to hear from you. Have you ever been tempted by promises of easy wealth? Have you fallen for sophisticated-sounding schemes that turned out to be traps? Have you lost money chasing returns you didn't understand? Or maybe you're standing where I stood 5 years ago, looking at an opportunity that seems too good to pass up, hearing the voice in your head saying, "This time is different." Share your experience in the comments below. Your story might save someone else from the mistakes we've made. And if you're just starting your financial journey or trying to rebuild after your own setbacks, remember this. The path to real financial security isn't sexy. It doesn't make for exciting dinner conversation. You won't impress anyone with stories about your index fund returns, but you'll sleep at night. You'll build actual wealth, and you'll reach your goals without risking everything you have. Subscribe to this channel for more real stories about money, business, and the hard lessons we learn when we stop listening to the noise and start building on solid ground. Because the best investment you can make isn't in any stock or fund or trading strategy. It's in your own financial education. Learn the basics, master the fundamentals, understand what you're doing before you risk what you have. The trading floor will always be there, promising quick riches and easy returns. But real wealth is built on one boring, disciplined decision at a time. Trust me, I learned that lesson the expensive way, so you don't have to.